presentation contains current opinions of Moez Ansari, Chief Investment Officer of Compac Asset Management, a registered investment advisor, and are subject to change. Nothing in this presentation should be considered investment advice. We make no assurance that Mo's opinions or illustrations will accurately predict future prices or financial markets. In no event is past performance a guarantee of future performance. A detailed disclosure can be found at the end of the presentation. And now here's Mo.
Hello, everyone, and welcome to the Compac YouTube weekly update for June the 17th, 2025. I'm Mo Ansari, President of Compac Asset Management, and thank you for joining me today. First of all, I want to remind all of you to click on the subscribe button so whenever I do an update, you'll be notified and you can watch it at your convenience. Looking at the numbers last week, the market, especially on Friday, came down after the Israeli strike on Iran, and that's causing a lot of anxiety in the market. Also, we're seeing anxiety on the big, beautiful bill that was expected to be passed through Congress or through the Senate, and we're seeing that might be slowed down. So last week, S&P down 0.36%, the Dow was down 1.3%, the NASDAQ down 0.61%. So all of the markets were lower, and we did see some reprieve yesterday, but now we're coming back down. It just depends on what the outcome of this war is in the Middle East. If it's just Iran and Israel, they go figure out, we get some negotiations, the Iranians give up their nuclear weapons, then I think we come to a very good resolution. On the other hand, if it expands and we decide to go in and help Israel, and then who else gets in, that's going to be a lot messier. And that's what the market is upset about right now. Energy was up big last week. That was the biggest gainer. Financials were the biggest losers on the week. Looking at oil, it jumped up last week, but it came back down, went yesterday, went back up today. It'll depend. But we are not as dependent on oil from the Middle East, and I'll show you a chart in a bit. Interest rates were down big. We got the inflation numbers last week. They were lower than expected, and that is showing a pullback. The economy is slowing. Today we got retail sales. They were much lower than expected. We saw the home builder sentiment. That's as low as it's been since the pandemic. So we are seeing some weakness in the hard data that we are getting. And that is why I think it's time to be a little bit more cautious in the market right now. Talking about oil, we are importing less oil from, especially on the Middle East. We are now net exporters of oil. You can see these are net imports. That's what it is. We are importing less oil right now than we have any time since the 60s. So because of fracking, it has changed the equation. Usually when there was first bullet fired in the Middle East, oil used to spike, and we used to see a dramatic decline in the U.S. stock market because we were so dependent. But now Europe is very dependent on oil, and the big thing that has changed over the last 20 years is China is very dependent on Middle Eastern oil. That is why, what do the Chinese do to protect their oil flows to their economy? Are they going to come and help out Iran in this situation? And that is something that I'm concerned about in the long term. So we will wait and see how this plays out. But wars usually are short-term pullbacks in the market. As soon as they're resolved, market goes right back up. But it depends on how widespread this thing gets. If it's just still Iran and Israel, I think it's not going to be a problem in the short term. But if it starts to expand, the United States starts to get involved, and then the Chinese start to get involved, it becomes a lot messier. We saw inflation numbers last week, a lot lower than expected. Again, as I've said, I think tariffs are going to be deflationary, not inflationary. There could be a little small increase in prices initially, but in the long term, tariffs, as prices go up, people buy less. It's that simple. And when people buy less, that's deflationary. And that's what we're seeing with retail sales number today, down 0.9%, much more than expected. Also, we're seeing that it was expected to be down 0.6. It came out down 0.9%. So that was a lot larger than expected. And that's why I think the economy overall is going to continue to slow. Looking at the technicals, we made a third wave top. Now we're getting a fourth wave pullback. Everything moves in 5 waves. This was the third wave top, fourth wave pullback, fifth wave high. Then we got an ABC correction. When we see 5, After that, we go A, B, C, or 5 waves to the downside. Now we've got 1 wave to the upside, 2 down, 3 up, 4 down. How far down are we going to go? First support is 59.42. That's a 20-day. 200 days, 58.11. I think we get somewhere between 58 and 57.50. Why 57.50? That's 57.67 and 57.50 are the 20-week moving average and the 50-week moving average. Looks like we've completed wave 3 on the weeklies, wave 4 to the downside. That's where we got to in April. Then we came back up dramatically. Now, but fourth waves are messy. They go up, they go down, they go up, they go down. They're not just straight down like wave 2, which comes down. It's a simple wave. But these are usually, wave 4s are much more complicated. We might see some more pullback here and then back up. The target still is around 5,300, 6,300 up here. That's where the long-term target is. But each one of these bars that you're seeing is a 1-week bar. So it's a long-term chart that could take another year to get to the 5th wave top. NASDAQ, same thing, 3rd wave top, the 4th wave. This is a big gap right here on the charts, which is somewhere around 18,000, just below 18,000 to about 18.5. That was the big move up to the upside when we saw the tariffs being delayed in the middle of May. So we could come back down, test that low somewhere around 18.6. We're at 19.5 today, so 1,000 to the downside. Weeklies, again, long-term on the NASDAQ, still positive, but 18.4, 18.5 is support right here at the 20-week and the 50-week moving average. Yields, as long as they're somewhere between 4.5% and 4%, just going back and forth and back and forth and back and forth, we're okay. The rates go sharply higher, that's not good. If they go sharply lower, that's not good. As long as we stay between 4, 4.5, we're okay. The market can live with it. Gold, the anxiety level went up last week, so people run to gold when there's anxiety. We saw a sharp run up on Friday, pull back yesterday. Today we're up or down slightly, just back and forth again. Depends. This all depends on how the situation in the Middle East evolves. Crude oil, sharp spike up in oil, big down yesterday, big up today. We're up about $3, $3.50 a barrel today. Big number is this $80 a barrel, which was the high that we made in January. As long as we don't get above 80, we're okay. If you start getting above 80, that's telling us the war is expanding in the Middle East. And that does not hurt us as much. I showed you the chart earlier because we're net exporters of oil, not importers overall. We are importing less oil than we have in the last 50 years. But the global economy is dependent on oil. The Chinese economy is very dependent on oil, especially coming out of the Middle East. And Iran is one of the largest suppliers of oil to China. What happens to Europe, which again gets a lot of its oil from the Middle East, and if oil prices go up, that'll impact their economy. So global economy would not do well, and that could definitely have a cascading effect on our economy overall. So that's the way I'm looking at this. And I think the bond market, I talked about that a lot on the podcast with Javed. We did that. Again, you can subscribe to that. It's free of charge. His indicator, the high yield bond in the bond market is getting anxious. That's the canary in the coal mine. And that's telling us that things could get dicey before they get better. That's what it's saying. So now's the time to be cautious. Now, so many of you call me when the market is down and say, what do I do now? Well, at that point, you're already down. Now is the time when we're within 100, 150 points of the all-time high is to make the correct adjustments to your portfolio. Now is the time to have that long-term path, to have that financial plan so you know what rate of return you need to get to your get to your destination. Everybody says, well, I want to make as much money as possible. That's great. But then you're taking as much risk as possible. You'll go up, make some money, you'll go down, you'll lose some money, and when you add it all up over a year or 2 or 3, you've gone nowhere. The way to create wealth is have that long-term plan and be able to execute it. Have the right mix of assets, the bonds and the stocks. That's how growth, that is how wealth is created over a period of time. If you don't have that financial plan, give us a call right now. at 800-388-9700, or just send me an email at invest@compact.com. Invest@compact.com. We'll sit down with you. We'll show you where you are. We'll show you the net growth. And then again, if you have an account with Compact, you can try us out for a year. Everybody says, well, you do better when we do better and all that stuff. Yes, our fees are dependent on how well you do. But also, we do give you a 1-year free trial. If you don't like what we do after 1 year, we will give you all the fees that we charge you back. No questions asked. All you have to do is just make sure that you're headed in the right direction. If you don't call us, call somebody. Get some advice, because now is the time to do it, to make sure that you have that long-term financial plan done and you're headed in the right direction. Those are my thoughts. Don't forget to subscribe to this channel. Go to compact.com/YouTube. I will be back with you next week. Until then, good trading.
This presentation contains the current views and opinions of Moise Ansari, Chief Investment Officer of Compact Asset Management, a registered investment advisor. The views expressed are current only as of the date of this presentation and are subject to change. Nothing in this presentation should be considered investment advice, and nothing is personalized to any investor's individual circumstances. Compact Asset Management offers investment advice only after entering into an investment advisory agreement and gathering client-specific information about goals, objectives, financial status, and risk tolerance. This presentation uses terminology associated with technical analysis and provides charts to illustrate some of the concepts discussed. Technical analysis is a security analysis method with the goal of forecasting the direction of prices of securities or market indices through the study of past market data, primarily price and volume. We make no assurance that past performance or the use of technical analysis will accurately predict future prices. Further, a risk of technical analysis is that overfocus on historical patterns could lead to ignoring or downplaying security-specific concerns, overall market or sector concerns, or other factors, because we assume inaccurately that historical patterns will repeat themselves. In no event is past performance a guarantee of future performance.